Hello and welcome back to All Things Money. I'm your host, David Blain. During today's show, we're talking a little bit about real estate in the market, the state of the market. The first two segments we discussed almost exclusively the valuation of real estate, and in summary, the bubble has largely been popped out of real estate prices. We see pricing on various metrics moving back into the normal range or even low range for valuation. Now, that doesn't mean that prices are set to rise anytime soon. The section we're talking about right now is supply, because when you have, a price is a function of supply and demand. And so even though we've seen a lot of the excess worked out of the housing prices, I don't think we're quite ready to see an uptick in prices, but I do think the majority of the damage has been done. As I mentioned in previous segment, real estate is all local, and so these are generic type things for the U.S. housing market in general. We see that currently there's about 16.6 more housing units than households in America. We have to eliminate some of the excess supply. Households are not forming at the rate they typically do. You see a lot of demand for housing come from new formation of families, people moving out of their parents' house, people getting married. Well, a lot of people are delaying that because of the job market and other things. Speaking of regional versus national, I thought I'd take a minute here and talk about some really fascinating statistics. The excess supply is concentrated in very specific states. The U.S. Census Bureau has what they call census tracts, and 5% of the census tracts accounted for more than a third of all homes lost to foreclosure since 2008. And half of the foreclosures have occurred in 10%. So 10% of the census tract in America have accounted for fully half of the foreclosures. And so if you're outside of that 10% of the census tracts, things are a little bit more mild. But that kind of gives you an indication of how the regional nature of real estate impacts. But as I mentioned earlier, it still affects us as a country. If they're big cities, whole states like Florida are very depressed housing market. What's going to hurt everybody? We see that here in North Carolina, people up north that are typically a lot of retirees moving here and buying our house. If they can't sell their house in New York, what affects us here in our hometown of New Bern. Okay, so looking at the housing inventory, by our estimates, we're looking at somewhere around 800,000 plus excess housing inventory. Those are the for sale, for rent, and what we call the shadow inventory is the ones that really concern us. These are the homes that are owned by banks or other people that are underwater or foreclosed, but they're not on the rental market and they're not on the sale market. That composes about 3% of the whole housing market, which is a very high number. It's way above levels that we've seen in the past. So that concerns us a little bit. We are sticking with some of our previous predictions that we think that this excess inventory will probably be worked off somewhere in early 2013, maybe late 2012, somewhere probably in 2013, maybe on into 2014, we'll see a lot of this excess inventory worked off. And it's only then when the excess inventory is worked off that I think we'll have any reasonable chance to see housing appreciate on a national level. And of course, all this, if you're a real estate investor, all of this statistics apply locally. You just have to get the data for your own local market and apply some of the same principles. But we think that the housing prices have largely bottomed, but we've got to work off the excess inventory before we'll see houses actually start to rise. We've seen a tremendous increase in renters, about a 10.5% increase in renters since 2008, where the amount of people owning a home has declined from a high back in 2005 of around 69.4%. The last quarter, the data was down to about 64%. So we see downward pressure on home ownership could present some pressure on prices over the next several quarters. However, people have to live somewhere, and so what's been happening is there's been a large upswing in the construction of rental units, apartments, multifamily, and we see a lot of investors moving into these areas. They've been very instrumental in helping stabilize the housing market. You know, people have to have some place to live, so whether people choose not to live in a house or they get foreclosed, they need to go somewhere. And so this is where the rental market has taken up the slack, and we see very large jumps in multifamily and apartment housing permits. We see construction permits for all those increasing a lot over the last several years. Just kind of a little tidbit in case you're wondering, the median asking monthly rent is around $1,000 a month nationwide, just in case you were wondering about that. So we see that in the rental market, there's a lot of demand. Investors are moving in. They're putting money into multifamily houses. They're putting money into rehabbing single-family houses. They're putting money into apartment complexes. And this bodes well, especially for investors into the housing market. The last section I would like to talk about as sort of a subset is what we call senior housing. This also bears out the trends toward renting. You see the 55 and over crowd not as interested in owning homes anymore, that they are moving into the senior living, apartments, multifamily type retirement communities, assisted living and things like that. And that type of construction has been going up significantly, and it's expected to continue to go up according to the Home Builders Association surveys that they do of builders. They continue to think this is a good area. Well, we're running out of time here for the show today on real estate, so let me just kind of summarize for you that we think real estate pricing and activity on a nationwide basis is sort of back to what the old normal would be, you know, the pre-bubble. The pre-bubble prices have been effectively deflated. But prices won't begin to turn higher until the excess supply has been worked off, probably in 2013. So if you've got a 2 to 3 year time frame, we think now is a pretty good time to be accumulating real estate. If 2 to 3 years seems like a long time, you may want to wait till prices turn up. So for All Things Money, I'm your host, David Blain, and we hope you join us again next week on the same time and the same channel.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.